And hello everyone, and welcome back to my YouTube channel and this continuation of the insurance series, video number 3. Today I'm going to talk about the specifics on an HO3 policy for all you new homeowners to be. Stay tuned, we're going to get right into the video. HO3 policies are divided into two sections, section number 1 and section number 2. So section number 1 covers what are all of your dwelling coverages, right? Coverage A, B, C, and D. Section number 2 are coverages E and F. So let's talk about coverage number 1. That covers the actual dwelling, the actual structure. And in this section, you always want to make sure that the house is being covered at replacement cost value. Now, it's very important to note that replacement cost value and market value are two different things. And your lender, when you're looking to buy your house, is going to require that the property be insured at replacement cost value. This is something that the insurance agent will be able to calculate for you based on the square footage of the house, the characteristics, the finishes, the floors, the kind of roof it has, the year build, all those fun things. The insurance agent will be able to give you a number, and that's the amount of coverage that the house will need. The event that you're buying your house cash, obviously insurance is optional, but very important. So now I'm going to talk about coverage B, but before I do that, I'd like you to smash that like button and like this video, comment below, and share. Next off is your coverage B, which is the second coverage in your section, in section number 1 of the HO3 policy. Coverage B is going to cover your other structures, and that is anything that is not part of the main house. So whether it be a shed or a detached pool or an in-law quarters or, a little fountain that you have, or a tiki hut, depending. Sometimes they're not covered, but anyway, coverage B is basically an extension of coverage A, and that's why most of the time you're going to find out that coverage B is going to be 10% of whatever your coverage A is. So if, for example, you're insuring the house for $200,000, well, then your coverage B tends to be $20,000. But the good news is that if you don't have any significant other structures, most companies allow you to bring that down to even sometimes 0%, meaning no coverage on coverage B if you don't need it. But most of the time, ask your agent if they can give you either a 2% or 5%. And the reason I say that is because you can save money. And remember that when you're trying to structure the purchase of your house, your insurance is going to play a big role in the numbers. It's going to play a big role in what your final mortgage payment is going to be and whether you're going to qualify for that house or not. Next off is coverage C, and that is going to cover all your personal property. Anything that you can physically take out of the house is going to be covered under coverage C, which is personal property. On that, typically a policy is going to cover 50% of coverage A. But again, you can bring that down to 0 if needed. Most companies will allow you to do 10, 25 or 50%. So that's also something that you can play with when you're putting your policy together. One thing I like to add about coverage C is that you can buy it with either replacement cost value or actual cash value. And if you can afford to go for replacement costs, I highly recommend that, because like I used to tell all my insureds, imagine that you lose everything in the house and you purchased your bedroom set for $5,000. That's what your replacement cost value is. But if you went with the actual cash value, guess where you're going to go shopping for your furniture set once they cut you the check? You're probably going to end up going to Goodwill or any other thrift store, because the amount that you're going to get paid is going to be high, very, very much less than what you paid for originally, because they're going to pay you for an item that's been depreciated. And so our last coverage on section 1 is going to be loss of use, which is letter D, and that is money that is allocated in the event that the house becomes inhabitable. And let's say that your house burns down to a crisp or a bad hurricane comes, you can't live there. Usually the coverage limits on that is about 10%, or sometimes you can bring it down to a 2% if you're trying to save money, but that's money that's used in the event that you have to go live somewhere else. And guys, thank you all for watching. Thank you all who have subscribed to my channel. The channel is growing. I am very, very happy that I'm able to show you and teach you guys whatever I know about insurance and real estate. In this video, I was talking about section 1. Next video is going to be section 2, which is going to be talking specifically about the liability coverages and HO3 policy. Don't forget to like this video if you learned something, enjoyed it, share it, subscribe, and comment below. Remember also, guys, that I am a realtor in the South Florida area, so if you know anyone who's looking to buy or sell, I am available. My information will be linked below, and anywhere in the nation for that matter, I can get you an experienced realtor that can help you through the process. See you guys in the next video.